Welcome back. You're watching Stock Picks. For today's segment, we unpack Grinrod, Argent, famous brands in Balwin with Anthony Clark. He's from Small Talk Daily Research. Anthony, always a pleasure. Good afternoon to you.
Yeah, good afternoon to you from slightly overcast Cape Town.
Always is a strange part of the country to be in terms of weather, Anthony. We've got lots to discuss here today. I'm keen to get right into it. And speaking about Cape Town, let's talk Balwin, because, of course, that was a bit of a shining star for them there, what they are seeing happening in the Western Cape.
Yeah, it was a glimmer of hope. The underlying residential DIY and construction market, as you know, has been under the whip for the best part of 2 to 3 years. The post-COVID hangover and the substantial rise in interest rates that consumers and citizens in this country have had to endure in the last 3 years has really hit the sector hard. And for the second consecutive year, Balwin has had a decline in underlying earnings, purely because people are just not buying any new properties. And we saw that in the results to the year ended February, where they actually sold about 32% lower apartments year on year. But the only bright spark, if you can call it that, is semigration from Gauteng and Natal to the Western Cape. Saw Western Cape apartments now nearly 50% of all the units that Balwin actually built in the period, and they built 1,892 units, sharply lower than the just under 2,900 units they tend to build year on year.
I actually want to speak about also what we are seeing coming out of Balwin. A very interesting one is the issue of Balwin sports, Anthony. And of course, we see paddle everywhere. It's a phenomenon. Then there's quite a few other sporting codes that they're interested in there. I'm keen to get your thoughts on that, if that might be something that is might turn into an annuity income, worth it for them from a group perspective to focus on, or just an add-on that may or may not do well and can even be sold off if it doesn't really add value as anticipated.
No, I think it's just an add-on. I think many of your listeners will know that many of the Balwin estates have lifestyle centres, they have gyms, sporting facilities, swimming pools, etc., etc. And I think what Balwin is trying to very cleverly do is build a community in these lifestyle estates to actually try and capture the underlying residents from rather going to external venues to keeping it in-house. And basically say, if you buy a unit in a Balwin development, we can offer you more than just living there. You know, there's normally dry cleaning, there's creches, there's a play area, a park, etc., etc. And this is just an added facility. So I think it's a very clever marketing move to try and add more services to encourage people to buy at the Balwin estates. It certainly is not going to be a large money spinner, if at all. But what it does do, it just gives another reason for perhaps a resident to consider buying a Balwin property rather than going elsewhere.
And Anthony, a slight cut in interest rates. Should Balwin benefit immediately? Might that take a little bit more time? Is there a specific, interest rate cut, a number that we have to see before a company like this can start to see just a turn in its fortunes?
Yeah, that's a great question. I asked Steve Brooks, the CEO of this, yesterday when I spoke to him, and the day before. And, your guess is as good as mine as to when the Reserve Bank governor will actually cut interest rates. I suppose much depends what happens on May the 29th and the directionality of the election and who wins. But Balwin is still fairly hopeful that an interest rate cut of up to 1% will occur in the latter half of 2024. But they did caution people on the results call that there's normally a 6-month lag. So if there is an interest rate cut, let's say tomorrow, it'll only start feeding through to the company in about 6 months, because it takes time for the underlying consumer to actually adjust to lower interest rates. They have to apply, consider buying a property, etc., etc. So it's not like, flicking a light switch. Consumers are going to take a fair bit of time to consider spending what is a great deal of money on a new property, and they want, I think, surety that interest rates are going in the right direction. So Balwin says, hopefully, into 2025, things look a little bit better for the company, and more so in the second half of 2025.
I want to move on now to famous brands, Anthony. Also keen to get your thoughts here. I think they recently also released some numbers, 8% increase in revenue. But this did not quite trickle down to the bottom line, which is, I think, very... confusing, as the word I'm going to use here. It's burgers and pizzas. This is stuff South Africans love.
Yeah, it's true. Famous brands, as I've often written, is the 800-pound gorilla in the fast food sector. They've got about 2,500 units spread across brands that we all know, like Wimpy, Debonairs, Fisherways, Mug and Bean, etc., etc. But they have two distinct areas Famous Brands is actually a manufacturing and logistics business, and where they make a great deal of money. And the underlying franchise fees from the restaurants is a nice to have, but they have two distinct sides. They have the what they call the signature brands, which are the fancier sit-down operations, and then the normal takeaway fast food operations. And Famous Brands have been very good at running, the fast food steers, debonairs, etc., etc. But the sit-down operations have really not got the traction in the last few years post-COVID. They seem to have sort of, hit a rut where people are very happy to like rush in and grab a meal and to leave. But we don't really want to sit at a Famous Brands store and sit down and get something to eat. Where Spur Corporation have done that very, very successfully because that's all they do. So I think in Famous Brands' case, the market is a bit concerned that they've lost their way a wee bit, particularly in the sit-down area. And as you say, they had an 8% rise in revenue to just over 8 billion rand. But the operating profit for the period was down 6%. HEPS fell 5%, and they cut their dividend by 17% because the company is still labouring under the disastrous acquisition they made in about 2017 of Gourmet Burger Kitchen in the UK just before Brexit, where they paid about 2.3 billion rand, and quite frankly, in a year or two after that, it basically fell in a heap, and they had to impair it and write it off. So they're still recovering from that disastrous acquisition in the UK. So I think the market is still waiting for Famous Brands to find its feet. And that is clearly evident in the last 2 years. If you'd been in Spur Corporation, you'd be up 25%. If you were in Famous Brands, you'd be down 25%. Wow. So it's a 50% straddle if you're running some form of directionality hedge fund. So Famous Brands, to me, needs to find its footing, decides where it wants to be. And intriguingly, in results, they did indicate that certain assets would be for sale. They didn't name them. But if I was a betting man, I would wager that some of the signature restaurants, the sit-down ones, would actually go so they can concentrate on what they do best, which is fast food and fast takeout.
They also mentioned in their results, Anthony, that they wanted to maybe do a little bit with their manufacturing and logistics business. I'm wondering if that could be a place of value, if they optimized, innovated in that environment, that could really, counter that cost line and do better for them in future.
Yeah, again, what they've done very successfully over a number of years is that many of the products that the franchisees tend to use, like sauces and ketchups and burgers, they tend to supply from centralized kitchens. And as such, they trap margin along the way. So I think what Famous Brands intends to do is to try and provide more product and trap more margin, because at the end of the day, the days of going into a restaurant and having a pump action sauce dispenser where you can just pump as much as you want, actually costs the money. Now it's a little sachet if you're lucky, and a little dribble of sugar or salt, but it all traps money in the business. So I think Famous Brands have done an extremely good job in controlling their logistics, supply chain, and manufacturing to try and trap margin, and that's what they do extremely well. And I think that's an area that they will continue to expand going forward, and that's where they really make most of their money anyway.
Last one on this one, moving into the Middle East, do you think that's a good idea for them? We know lots of Western brands have lost favor in that environment. Famous Brands could actually thrive there, Anthony, but I'm wondering if they've got the fundamentals going for them.
Yeah, I think we've seen many fast food companies move overseas. Spur Corporation and Famous Brands have moved into overseas territories, and in many cases they haven't done very well. They've been badly burnt in the UK, Australia, New Zealand, and Ireland. And in Africa, they seem to do very well. And many are now looking to the Middle East, particularly the United Arab Emirates and Saudi Arabia, to try and take the more upmarket products, which are perhaps halal friendly, into those markets. When Famous Brands owned Tasha's then bought the business back into family ownership. And they've expanded very aggressively into the Middle East and now doing exceedingly well. So one would imagine that Middle Eastern markets would be attractive. And let's not forget that President Ramaphosa did actually sign a number of trade agreements with Saudi Arabia last year to make South African agricultural and food products far more accessible to that oil-rich country. So I can see many companies wanting to jump on the bandwagon and potentially use those government ties and open up in wealthier countries.
Let's move on now and talk Argent, less consumer-facing, still a products manufacturer. We know this is an industry that has been an ICU over more than a decade, consistently declining. But I'm keen to get your thoughts on Argent and how it does play in the space.
You praising that stock so well. That's a perception that many investors have in the stock, but it's in a declining industry. It's in metal bashing. They're beset by electrification, union troubles, etc., etc. Except that they've completely reinvented themselves in the last 5 or 6 years by selling off domestic businesses, particularly the low-margin ones, to focus on exports. And now 75% of the group's profits are actually made in the United Kingdom. And with the rand having weakened substantially in the last few years against the British pound and the US dollar and the euro, Argent are coining it. And the current share price is trading at 20 rand 93 cents, which is a near another 52-week high. And I was doing my notes before we came on air. This is one of the best performing small caps in the sector that I've tracked. It's up nearly 600% in the last 5 years. And very few major institutional investors actually own it because it was a micro cap. It was valued at only a few hundred million rand. It's still only about 1.1, 1.2 billion rand. But with a growing rand hedge exposure, and they've had now 9 consecutive periods of earnings growth, a net asset value of nearly 30 rand a share, the stock still is on a PE of under 4. But it's one of those stocks that's like Marmite. You either hate it or you love it. Most institutions can't stand Argent, but many of the private clients who understand the growth story and the move offshore have made very, very good gains. And as I said, you could have bought this stock at about 4 rand in early 2019. Today, it's nearly 21 rand a share.
It is a very, it's funny what you say, that it's a lot like a Marmite here. And as I was reading, it really was important to see how it does export to the rest of the world. And of course, right now, even if you look at the stock, Anthony, the world is kind of in an economic downturn. Should the tide turn and demand increase for a company like Argent, they could grow, and that 600% could, still see a lot of upside.
Yes, and their main growth markets are offshore. I don't want to bore the listeners with their range of products, but it tends to be tied with products that are in natural demand. For example, they have a really interesting and highly profitable business moving fuel around certain UK airports. Now, again, post-COVID, when everyone started to travel by aeroplane again, there was demand for airline fuel. And we all know that airline companies are currently doing extremely well as everybody is flying around the world. So Argent's fuel business is doing exceptionally well. And with the growing rise of health and safety, particularly in Europe, the demand for health and safety doors and other related equipment, again, is never not going to go up. It's going to always have a natural market. So I think Argent has been very clever in positioning its offshore acquisitions, small as they are, into areas with natural growth vectors. And again, exporting, in a rand-based economy and selling in a hard currency-based jurisdiction is only going to bring them benefits, unless we suddenly believe the rand is going to be extremely strong against the euro, the dollar, and the pound. It has been in the last couple of months, but I think the longer-term trend, as we all know, is weaker rand going forward. So it should benefit companies like Argent, and it's still quite small. The discount to net asset value remains still very attractive. A stock that I've covered for 20 years and still looks very interesting on a PE of just under 4.
Talking about exports, let's talk Grinrod now. That's also a company that I always say was at the right place at the right time, and with its management has managed to really just take advantage of what we are seeing here on the continent, here in South Africa. Let's talk about the exciting prospects for this business as well, Anthony.
Yeah, again, another great recovery play. This stock was one that I highlighted back in November 2020 at about 3 rand 71, when nobody would touch Grinrod with a barge pole. It was a hodgepodge of disparate assets. It had agriculture, private equity, there was a bank, there was a land, there was a taxi business, and the real sexy parts of the business, which was ports, rail, and general logistics infrastructure, was basically a nice to have, but it was being drowned out by all the noise. And the previous CEO, Andrew Waller, did an exceptionally good job in cleaning up the business, selling off unwanted assets to focus the company back on what everybody knows Grinrod is. It's ports, rail, and logistics. And as we all know, in the last couple of years, given the decline in certain state-owned enterprises in this country, like Transnet, Portnet, amongst others, that the demand for industry to use a private supplier of port and rail assets to get their product from where it's produced to port is growing exponentially, because Transnet and Portnet, quite frankly, are not doing a particularly good job. And I'm trying to be polite here to those state-owned enterprises. And we've seen hundreds of billions of rands of revenue and lost taxation to the fiscus, basically vanished because the government cannot do the job properly. Companies like Grinrod have jumped on the bandwagon, excuse the pun, and put down trains and improved ports, particularly in Mozambique. And companies are using those facilities. And the share price, as I look right now, is trading at about 14 Rand. It's up about 20% year to date, but it's up nearly 300% in the last 4 years, as the market has suddenly realized that this company is in the right space at the right time, as the government is looking for public-private partnership to assist the government in uplifting rail and ports. And I think Grinrod is one of the very few assets listed on the JSE which gives investors a direct touch point to an area of the economy which has natural growth and we all know needs to improve. So Grinrod to me has been one of my top performing stocks for the last 2 years, and I have no reason to change my mind. It is chuffing, doing extremely well.
I must ask you, Anthony, why investors seem to overlook it. It is undervalued. I mean, you said it's trading around 14 Rand. I'm wondering how much upside you believe is still available for this company. It really is, like you're saying, a great company, but it doesn't really reflect in that share price.
Yeah, a lot of the easy money has been made. As I said, you could have bought this stock 4 years ago when most people didn't even give it a second glance. And its real good year was 2023, where the stock virtually doubled in the year. As it stands right now, it's still trading at a premium to its net asset value. But the real inherent value in Grinrod is what would somebody be prepared to pay to basically get a foot in the door at one of the biggest public-private partnerships in the African continent to open up railways and the ports in what is Africa's largest economy. And I think that's a price that everyone is salivating over. There's been some substantial transactions in Africa with Dubai Ports International and some French companies buying assets in Africa for juicy, juicy multiples. And I think many of the institutions out there are seeing not just natural earnings growth in Grinrod, but the potential for an international player to come in and say, listen, we want to participate in African infrastructure. Southern Africa is a great bolt-on to our global network. We are happily prepared to pay 16, 18, 20 Rand a share. So you've got a double-edged sword in Grinrod in terms of natural earnings uplift and potential M&A going forward. And I think that's what keeps the stock looking fairly interesting from an investor's standpoint.
Absolutely, even better, Anthony. It's all we have time for. Always a pleasure speaking to you. Thank you so much for taking us through these 4 counters today. That was Anthony Clark from Small Talk Daily Research.